All right, so we're going to get started up. Looks like we're at the bottom of the hour. This is Think with a Drink, the weekly webinar series brought to you by the Aries Foundation for Financial Education. This week's episode, this week's topic, we're going to do life insurance questions and answers. A couple of quick, real little pre-flight checklists for everybody, just so you know. The event is being recorded. Just keep your microphones muted. They should be muted anyway. You don't have to worry about turning your cameras off because your image, your picture is not going to be shown even though we're recording. We're only recording what is on the screen. There is a chat box. However, as it says there, my co-pilot has abandoned me again this week, so he's not with me. And just know that if you drop any questions in, I will try to get to them at the end because I sort of lose that functionality when I'm in this presenter's mode. Speaking of your coaches for this evening's journey, my name is Tom Alessi. I am the president of the Aries Foundation. I've been an investment advisor for 23 years. That means I'm a fiduciary. I'm compelled to act in the best interest of my clients whenever I'm giving any guidance or advice. Normally, I would bring my co-pilot in, Craig, who's the vice president of Aries, but he's abandoned me again this week, so I'm flying solo. So just understand that as we go through this. So I told you that the Think with a Drink is brought to you by the Aries Foundation for Financial Education. We're a nonprofit. You can visit us at www.ariesfoundation.org. Just know our mission statement is trying to help everyone have a better relationship with their money. Because whether you realize it or not, you're in a relationship with your money. And just like every other personal relationship that you might have, there are emotions and behaviors and triggers that cause us to act irrationally sometimes when dealing with our finances. Our mission at Aries is just trying to take some of that emotion out of handling your money. Some disclosures, I'm not going to go through them. Just understand we're a nonprofit. We do this for educational purposes only. We share the recordings on our YouTube channel. We share them on the website. So if you're ever going to share the information, please just do it in an educational manner, which gets me to the fun part because, see, there are drinks on this flight. We call it Think with a Drink because we want it to be more casual, more relaxed, and we can't think of a better way to do that than if you have something cold to sip on as we go along through the presentation. This evening, because I'm coming to you live from Cape Cod, Massachusetts, I am drinking Cape Cod Beer's Red Amber Ale. Cape Cod Beer's little tagline is it's a vacation in every pint. I happen to be a big fan of their Red Amber Ale. So that's what I'm drinking this evening. So everybody, skål. All right, life insurance questions and answers. So some sobering statistics, if the pandemic, if COVID taught us nothing, it was that the number of U.S. Population that is underinsured, whether we're talking life insurance, health insurance, any type of insurance, specifically what we're talking about here, though, is life insurance. And, the stat that comes from lifehappens.org, they're another nonprofit. You can check them out. 85% of Americans say they would like to have life insurance, when the reality is that only about 62% of the population actually has life insurance. And, some deeper dive into that is that, over 60% of males, of men, have coverage when only 56% of women do. And a large slice of the married population, 40%, says they wish that their spouse, in this case, women saying that would prefer that their men had more insurance coverage on them. So why is it? Why don't we have insurance? Well, there's a couple of reasons. One, it's too confusing. Two, it's too expensive. That's what we hear a lot. And three is, do I really need it? And we're going to go through that with some of this with the questions and go through and try to answer some of this and some of the more relevant or prevalent questions that we get asked a lot. But let's break it down for you in the types of policies that are out there. And just so you know, we break everything down into two different categories. You have term insurance, you have permanent insurance. I'm going to break them down for you in a second, in a different slide in terms of it. But just understand that in each of them, they come in different types of flavors. In term insurance, you have guaranteed, you have annual renewable, and you have return of premium. I'm going to break those down in a second. And then when we get to permanent, I will break down whole life, universal life, and the hybrid versions that go on. But this is where some of the confusion comes in. Like, well, wait, what does this policy do versus that one, and how does it all work? So just know that as far as the grand picture of everything, you have two separate categories: term insurance, permanent insurance. So what is term insurance? Term insurance literally just means they are covering you for the time period of the term. Whether that term is 1 year, 5 years, 10 years, you can even get 40-year term insurance nowadays, depending on your age, and you can qualify. But they're going to cover you for that period of time. In the guaranteed version from the last screen, the guarantee is just for that period of time. So whatever the premium is, and let's just say the premium, just sort of an easy number, was $100 a month, and it was a 10-year policy. Well, the guarantee is that if you pay $100 every month, they will guarantee that that coverage is in force for that 10-year time period. At the end of the 10 years, they don't have to continue it. Most of them will give you the opportunity to continue it or convert it or do other things with it. But just know that term period, that $100 a month, that ends at that time. And the thing with term insurance, it's low cost because they're only covering you for that period of time. Less than 2% of all the death claims that were paid out last year were paid out through term insurance. They have actuarial statistics, mortality tables to tell them more than likely you are not going to pass within that time period. Term insurance does not build up any cash value. It is purely insurance, just like your car insurance or your home insurance. You know, the hope is that you don't ever have to use it, because if you do, you're dead, basically. You know, you've passed away. That's term insurance. So the annual renewable, just to touch on that, because I just want to make sure I cover the three types there. Annual renewable is it's a 1-year term. And every year, they give you the opportunity to renew the coverage. It's guaranteed renewable every year. It just, what happens is you're getting older, and age is a factor in terms of cost. So as you have that policy for longer and longer time periods, the cost keeps going up incrementally every year. The last one was return of premium. Now, this just says that at the end of the term, if you're still alive, they haven't paid out a death claim, the insurance company is going to pay you back all the money that you paid into it. This sounds like a good idea, right? Less than 2% of the death claim. So more than likely, I'm going to get to the end of the term and they're going to give me all my money back. Tom, that sounds like a great idea. Yes, but there are a couple of things to realize with that. One, there's a surcharge on top of the premium for that privilege of having that return of premium. So it costs you more than a traditional term policy to have that come back. And then, whereas in a traditional, straight, pure term insurance policy, you can walk away at any time. Once you stop paying the premium, there's no cash buildup, there's no penalties or surrenders or anything that goes along with it. You can just walk away. If you're in a return of premium policy, as a 20-year term policy, and you want to walk away in year 9 or year 10, well, you're not going to get anything for that. You would have paid that extra surcharge for all that period of time and not gotten anything out of it. So you got to be really careful with that. And the last one on return of premium is there aren't that many providers left that do it, that actually have a policy available. So you're limited in terms of your shopping and the availability of coverage for that. All right, so term versus permanent, what's the difference? And I certainly hope I'm going to have the ability to play this video.
This is you. Your life has significant value to your family and your community. How do you replace that value if you're not around? Life insurance can help protect your financial worth and make sure that your family continues to thrive after you're gone. You have two options. Permanent insurance provides you lifetime protection. That means for your entire life. Whenever you die, no matter when it is, your family will receive a death benefit. Term insurance provides coverage for a specific period of time. If you die while the term insurance is in force, your family will receive a death benefit. If you die after the term is ended, then there's no benefit paid. So So how do you decide which option is for you? In some ways, it may be easiest to compare the two types of insurance to renting or owning a home. When you rent a home, you pay an established amount every month to live there until your lease is up. At the point the lease ends, you have the choice to renew for another contract period, at which time the price you pay may increase. The money you spend in rent is less than the cost of owning a house, but it does not build equity for the future. Term insurance is similar to renting. You pay a premium based on your contract, and once that contract is up, you no longer have access to the benefit. When you purchase a home with a mortgage, you agree to pay a monthly fee for the lifetime of your loan. Your mortgage payments can build equity in your home over time, and when you've paid the mortgage off, the property is yours. Permanent insurance is similar to buying a home. You sign a contract to purchase the benefit, and you pay a fixed premium for the life of the contract. As long as you pay your premiums, you own the benefit for life. If you have a permanent policy, you can accumulate cash value over the course of the contract. The good news is that you don't have to choose one or the other. If appropriate, term insurance and whole life insurance can be used in tandem to protect you through the stages of life. To learn.
Got questions? Ask us. We can help with that. Visit our website, www.aresfoundation.org, to learn more, or you can email us directly, info@aresfoundation.org.
That was me doing that little blurb there at the end in case you didn't pick up on that. So, all right, how much life insurance do I need? Right. So the dime method here is just one method. So there's a lot of different, and this is where it gets confusing and where it gets a little bit convoluted in terms of trying to figure this out. Right. So this just says, all right, I've got debt, whether that's a mortgage or, debt that's not mortgage. I've got my income that I've got to replace. I've got a mortgage that I want to get paid off. And maybe I've got kids and there's future education needs that I want to build into it, right? So that looks at all the stuff that you might owe. And then if you have some insurance, you just minus that or take that off the table. And then there's where you come up with the method. That's the dime method. The other is just to say, look, take whatever your income is, depending on your age, and then go out at least, if you're in, say, your 40s, go out 10 or 15 times that number. And that's going to give you, there's what you probably should have for a policy. So if you make $100,000 a year and you're, say, 45 years old, you should probably have at least $1 million in coverage, just to give you a sense of what you should have available. How you have that coverage, like the video just said, whether that's a portion of it in term, a portion of it in permanent, and some sort of mix of that way to make it cost effective, that's a different conversation. But the total number is really, either of these two methods could certainly work for that. All right, I get life insurance through my employer. So am I all set? Well, you have coverage, certainly. And if we were looking at the previous screen with the dime method, then you would have some coverage that you at least say, I've got some coverage in place, so that take that off the total that I have. The problem with coverage through your employer is that, when you leave, so doesn't the insurance. You're not covered once you stop employment. And in today's world, we are job hopping more than ever before. Before we were long-term employees. We're going to spend a life at the company. Well, nowadays, the company's not around for our lives, or the ability to do that isn't around. So we have a tendency to move. And once you move, the coverage that you had in place is now no longer there. You have to sort of think about this as sort of you are the CEO of you. Right? As part of that, you should have a benefit package that goes with you as the CEO when you move. And one of those components is a life insurance thing. Disability is another, having an IRA or a portable retirement account that you can bring with you. These are all facets to being the CEO of you. But having an insurance policy so that when you leave your employer, you don't have to worry about the fact that you have no coverage. That's one thing that absolutely everybody should be considering. Okay, what about buy term and invest the rest? So this is the conversation that mainly came out of my industry, out of the financial services world, which is to say, hey, the cost of that term insurance, it's really, really cheap. That permanent is 10 times more expensive. Why don't I just buy the term policy? I'm going to then take the difference and I'm going to invest that into some sort of stock, mutual fund, portfolio, whatever. And then when I get to the end, I'm going to have this pile of money that I can use. That's going to have more money in it than what that cash value would build up in the life insurance. That's the idea behind buy term and invest the rest. Here's the problem with it. There's a couple of issues when you're trying to compare the two. They're not the same thing. Trying to compare the cash value permanent life insurance with the Vanguard S&P 500 fund is not the same thing. Those are apples and oranges. But more to the point is, for most Americans, and not to diss anybody in the audience, but the idea that you are then taking the difference in the premium and what it would have cost you to buy permanent coverage and actually putting that into an investment account on a monthly basis out over the time period of 15, 20, 30 years, in reality doesn't happen. We're not good at that. We don't do it. So to say the concept, buy term and invest the rest, that's great. But the actual forethought and going through it and actually connecting and doing that really doesn't happen. And then when you get to the end, right? So now you're 65, you're a 45-year-old, you bought a 20-year term policy. Now you're 65 years old. You don't have any insurance anymore. Okay, I've got this money. But now when I go to use that money, the market crashes. Then what happens? Now what's happened to my money? So there's all sorts of things. There's good and bad depending on what you're trying to do. I'm not trying to dissuade you from doing this. Our goal here is to make sure that you understand that these are really two separate conversations, permanent insurance versus term and investing the difference. But they should not be what happens for most financial professionals, financial sales showmen, the people on TV, those folks, they try to move them and make them the same thing. And they're really not. They're two separate conversations. They're two separate things, and they need to be treated separately and differently than instead of trying to treat them as the same type of conversation. Do I need to take a medical exam? So the answer there is, in today's world, more than likely not. The old world, yes. Today, there are more and more providers, dropped into the chat box if you want to take a look at it. We've got a link to, it's an online thing. Basically, you pull up the link, it'll ask you a couple of questions, and then ask you a couple, fill in some details, ask you some history questions about if you take any meds or if you've had any issues, and it'll tell you right then and there. There you go. There's no more of this, like I call the ickiness, right? There's no more, needles and drawing blood and having to sit with a nurse practitioner and go through any of that. You can just answer a couple of questions and get it. It's called Simplified Underwriting. So depending on the company, you can go anywhere from 200, 250,000 to we've got access to one that can go all the way up to $1.5 million this way, where you don't have to draw blood, depending on your health. Like if you're, fairly healthy individual, you're more than likely going to be able to get by without just answering some questions and not really having to do anything else. So the answer there is depends. If you're somebody who's had issues, you've had medical concerns, you're taking certain prescriptions, then more than likely you're going to have to go through the traditional method anyway. But you can find that out by simply going to the link that's in the chat box and answering a couple of questions. Can I name anyone I want as a beneficiary? Yes, you can name anybody you want as a beneficiary, right? So you can name multiple people. If you've got several children, you can name them. Just know that they always have to be round numbers. You can't do, 33 and a third, 33 and a third, 33 and a third. One kid's got to get 34, the other two got to get 33, or however you want to manipulate that out, just round numbers for all of that stuff, right? So you can name anybody you want. You name spouse, you can name children. Most of the times what we suggest that you do with beneficiaries, very important, is that you name a primary and name a contingent. And a contingent beneficiary just means the person that's backing it up. Should something have happened to the primary, the contingent then becomes the primary beneficiary. In the case of, a family, you name your spouse as the primary and then the children as the contingent. Something happens to your spouse, then the children automatically become the beneficiaries. You should always, always, always recommend going back and reviewing beneficiary designations, whether it's on a life insurance contract, whether it's on a retirement account, any benefits you get through your employer that you're naming somebody else on, every few years, 2-3 years, just go back and just check them all. Make sure that all the information is correct and it's up to date. Always a good idea to do beneficiary reviews, right? You can name a trust. That's, one of the things there. You don't have to name a person. You can name a non-entity. Most of the time, that non-entity is a trust that has been set up, but you can also name a institution. You can name a financial institution, a charitable organization, and name them as the beneficiary. So there's a lot of different things you can do with beneficiaries. That's one of the nice things with life insurance, because it does not pass by a will. It passes by beneficiary designation. So you can go right around and just name anybody you want. So always know that is part of the freedom to be able to do it. All right, so I vape. Am I still considered a smoker? So in today's world, for most insurance companies, that answer is going to be yes. You're still going to be considered a smoker. For those who don't know, smokers are treated, generally the premiums are run anywhere, usually about 40% higher as far as cost is concerned. That's why sometimes you'll hear, hey, it was too expensive. Well, you're a smoker or you're not in good health. So we'll talk about that in a second, about the things that drive those premiums to go up. But smoking is the biggest, right? Smoking, that's an automatic increase, and they're going to, depending on you, that increase can be north of 40% of the actual cost of the premium. Now, I say that there are a few exceptions. There are a couple of providers out there that if you do vape and you don't smoke anything else, any other cigarettes or anything else, there is a way to get you non-smoker classification. So if you're interested in that, you want to learn about it, you can certainly reach out to us. It's info@aresfoundation.org. Just put the tagline, I vape, on it, and just we can connect with you and get you the information, let you know how that works, and the one or two providers out there that actually will classify someone who vapes as a non-smoker, save you, almost 40% on the cost of the insurance coverage. All right, so how can I save money on a policy? Well, we just talked about one of them right there, right? That's don't smoke, or stop smoking. But here's the thing. This is what drives most premium coverage. Health is a big concern. So they're always going to ask you questions about your health. Health being, have you had any serious medical issues? Do you take certain medications, high blood pressure, cholesterol, those type of things? All of those increase the cost. The other factor is age. Now, here's the thing. We can all try to be healthier in our lifestyles. We can exercise. We can, eat better. We can stop smoking. We can lose weight. We can do things that we can make ourselves healthier going forward. But you're never going to be younger than you are today. That's the reality. That's it. You're as younger as you are ever going to be going forward today, which means you're only going to get older. As you get older, the cost of coverage gets higher, whether you're talking term insurance or permanent insurance, because the reality is the likelihood you're getting closer to that end line. And if they have to pay the claim, they're going to charge you more for that. Now, gender depends on where you are. Some states, they're gender neutral. That means it's unisex between male and female. Most states, however, do still distinct between the two. So generally, females are treated much better in life insurance because, ladies, you live longer, you take better care of yourself than men do. So men, we tend to get shorted in that, and it costs us more for coverage, right? Hobbies. Driving record is another one. That's a big one. But hobbies. So, if you fly planes, jump out of planes, do crazy, hang gliding, all that kind of stuff, those are all things that are going to increase the cost. They're just looking at it as the possibility that something bad could happen to you. And so that's going to increase the cost of the premium. So just understand that when you're thinking about life insurance, think of it as how am I going to, project out how long I'm going to live? And in doing that, am I closer to the end line or much farther away? And that's generally going to be how your premium is going to be set up, whether it be low cost or higher cost, is going to depend on your health and some of the things that you do. What if I get declined? Right? So a decline on a policy, that just means you applied for coverage and the company came back and said, nope, we don't want you, you're out, right? This happens. This happens sometimes when someone who applies doesn't realize that there's a serious something wrong with them, or they didn't realize some of the medication that they're taking could be an automatic decline. That's why a conversation with your a professional agent with a professional insurance provider makes sense, because sometimes there are those triggers or those trip ups. And once you are reported as being declined, every policy after that is going to ask you, have you ever been declined for coverage? So you sort of want to take steps and prepare to say, gee, am I going to get declined if I apply for this? Is there something wrong with me? What about these medications that I take? Hey, I've got high blood pressure. What is that going to mean? So there's all these sort of factors to it. But just know, if you do get declined, if that ever does happen, again, reach out to us. We have different organizations, different places that we can help people go, that sometimes there are providers out there, because not everybody works the same from the insurance provider world. Some of them work better with more riskier cases and will tend to write it, whereas some companies don't want any of that risk. So if you go to them, and they'll just automatically decline you because they don't want you as a client. So you just got to know that before you begin the process. It's just one of those things to realize, but just understand a decline notice is not the end. It could be, but sometimes there are other places that you can go and actually get coverage to put in place. Do I really need life insurance? Well, here's the thing. Do you have someone who counts on your income? By that, I mean the money you bring in, you're responsible for some of the expenses to the household. If that's the case, you need insurance. Do you have a family? Do you have children? If the answer is yes, you need insurance, right? Even a single individual with no children, but you have debt, might make sense to look at getting insurance just so that debt gets covered and you don't have to worry about it when you pass if something happens tragically or unexpectedly. About the only people who don't need life insurance are the same people who don't need a will. You don't have anything. You don't have anybody that relies on you. Either that or you're immortal, right? You're never going to die. But if you're going to die, you should really consider looking at having some type of insurance, because it's only going to help those that you, or who count on you, or the loved ones that you have, because that's what it's all about. It's all about protecting them if something happens to you. I mean, it's called life insurance. I said that out in one of the emails, but really this is death insurance, right? This is really what happens to you if you die. And what happens to you is, who are the people who are counting on you, who need you, who are looking to you for support and for help And if you're not there, where are they going to turn to get that? And that's what a life insurance policy can do. It can give them the ability to stabilize and control what they're doing going forward. So this is a lot to deal with. It's a lot to go through. You know, for Aries, we're always talking about trying to help everybody get onto the path, get onto the right road, have a clear vision of where you want to go. Insurance is one of those murky, cloudy things that comes up. How much do I need? What do I want? Where should I go? What type of policy and what works for me? That's more of a one-on-one conversation. Really need to have that more in-depth conversation to be able to do that. We're happy to do it. It's part of what we do. You know, we say to everybody, just reach out to us. If you type yes in the chat box, we'll make sure we get to you. But if you reach out to us, we'll go through this with you. We'll do a complimentary overview and just determine what makes sense for you, for your family, for what you've got in terms of being able to budget and put aside to deal with it. This is Craig and I in our more formal attire. If you ever see us out and about, yes, those are our TB12 jerseys. He's still the GOAT. He's still playing, so we still wear them. They are custom to us. And let's face it, at this point right now, it's very hard to find a Mac Jones jersey anyway. We do like to send out in the chat box, you'll also find the link to our evaluation form. We value the feedback and support we get from everybody. So if you can just take a minute, just fill that out, send it back to us. We always like to see how we're doing. You know, if we're being topical, what are some topics or ideas or thoughts that you might have for an upcoming Think with a Drink? Speaking of upcoming Think with a Drink, what's on tap? So next week, we're going to do estate planning with long-term care. How do those sort of mix together when we're talking about an overview of planning? I'm trying to take care of my estate, my loved ones, my beneficiaries, but I also got to take care of me. The 25th is Thanksgiving. We don't do anything on holidays, so that's a happy Turkey Day to everybody. And then we'll come back the week after for I think there's 4 remaining to go out to the end of the year. I don't see any questions right now in the chat box, but let me just finish this and then I'll take a quick look. So you can visit the website, www.ariesfoundation.org. Again, you can email us at any time. That's info@ariesfoundation.org. And for those who are more apt to want to read, we do have a blog post where we do blog a couple of times a week on the subject matter that we're doing. And you can find that at ariesfoundation.org/blog. So with that, it doesn't appear there's anything in the chat box. I'm going to say good night and have a great evening.